Hello guys, welcome back. Brock Genie here, and in today's video, as I promised before, is that today we will see some of the pairs, breakdown analysis of some of the pairs, but also I will talk about transition and break of market structure. For those who didn't understand my last video, I talked about transition and break of market structure. So some of my subscribers asked me to make the English version, so here I am. I will explain about those concepts a little bit, but also we will see some of the pair, how they went last month, but also this month. Yeah, so stay with me from the beginning of this video to the end. So let's talk about transition. What do we mean when we say transition? In other name, they call it change of character, chochi. So chochi occurs when, let's say in the bullish market structure, let's say the market was trending up like this. This is higher high, higher low, higher high, higher low, higher high. So what we are expecting here is that we all know that after this break of market structure, after this break here, we expect the market to come within this level, this level, between this validation and this invalidation down here, and then moves above. So if the market in this level, we expect the market to move above to create another new high. But sometimes the market fails to do that. So when the market fails and breaks below this previous higher low in the bullish market structure, this is what we call transition. This is what we call transition. This is what we call transition. So transition in the bullish market structure, it occurs when the market failed to respect the previous higher low. When I say the previous higher lows, I mean this one. This is the previous higher low, because this was the higher high and this was the highest point. No, so if the market failed to respect this level and breaks below, it means this market gave us or created the transition structure. So after the transition, as we know, we don't trade after the transition. We have to see another confirmation, which is the break of market structure, which I'll talk about it later. So in the bullish market structure, how do we consider the transition is like that, the way I explained. But in the bearish market structure, it's the vice versa. It means this was the lower low, lower high, lower low, lower high, lower low. What we know is that in the bearish market structure, the market has to break these previous lower lows and form the new lows, but the market have to respect this previous lower highs. And if the market will come and close above this previous lower high, the market will now give us the transition. So the transition in the bearish market structure occurs when the market failed to respect the previously lower high. Before proceeding, I would like to share this tip with you, is that if you are looking for a good way to backtest your charts, but you don't have the money maybe to buy subscription from the TradingView or other platform, you can use this Trader View. It's free for 15 days. So once you register to this website, you will get 15 days for free, and you'll be able to cut the chart from the monthly to seconds, and you can put the multiple charts like this. So this website is very, very similar to TradingView. So if you know how to use TradingView, this website will be easy for you to use. So I will leave the link on the description, so just click that link on the description so that you can register today. So I will leave the link on the description, so make sure you click to get those 15 days for free. So let's continue with the video. So that is the difference in the bullish market structure, but also in the bearish market structure. But let's talk about break of market structure, and then I will show you some examples of this transition and break of market structure. So let's talk about break of market structure. Break of market structure, other people they call it market shift. It's okay. It's a matter of names, but it's the same thing. And the break of market structure in the bullish market structure occurs when the market breaks the previous high and form the new high. When the market breaks the previous high and form the new high, this here is where we get the break of market structure in the bullish market structure. But in the bearish market structure occurs when the market breaks the previous lower low and form the new low. That is where we get the break of what? Of market structure. So in addition is that many people are confused on the marking of this when it comes on the marking of these structures, whether transition or break of market structure, because as we know that we have different types of break. We know we have week to week breakout, we have body to body breakout, but also we have week to body breakout. So which of these three type of breakout we use when we want to identify the break of market structure or transition is that, let's say this is the bullish candle. Let's say this was the bullish candle again, and maybe this is the bullish candle. Then let's add another candle, which will be the bearish candle. So this is the bearish candle, let's say, and then the bearish candle, then the bearish candle. Let's say we have this bullish candle again. So when we talk about body to body breakout, is that the market, when we talk about the week to week breakout, we mean the market has to break this week by week. And what you have to understand is that in the market structure, every high and low has been created by two candles, which is in this high here, the high is created by the bullish candle and the bearish candle, but the low is created by the bearish candle and the bullish candle. So if you see in your your highest point has the longest wick, and maybe the other one is the short wick, you have to choose, or you have to take the longest wick, to consider the longest wick as the area where the market has to break, so that we can say the market has given us the break of market structure. So you don't have to, you are not supposed to mark this short wick. You have to mark the longest one. So if this is the longest, you will mark this one, but if this one is the longest, you will mark this one. Yeah, so you have to mark the long wick. So after saying that, is that when we say week to week breakout, we mean this week must be broken by the wick which is formed on this candle, which is found on the continuation move. So if you see this kind of structure, this is what we call week to week breakout, because this week this candle failed to break with the body, but also this candle give us the wick that close above this previous week. So that is week to week breakout, but we don't use that. What we use two types of break, which is the week to body breakout, but also body to body breakout. So let me talk about body to body breakout. When we say body to body, we mean that in order for us to say this is the break of market structure or transition, we have to see this previous body here, which forms the high, has to be broken by the next body. So if this body close above the previous high, but maybe didn't close above this previous week here, which is found on this high, still we say this is the break, because this is just the body to body breakout. But also, we don't use this breakout on our main or our constant time frame. We don't use this body to body breakout. We just use week to body breakout on our constant time frames. So when I say constant time frame, I mean 30 minutes and above. But when when we are in the 15 minutes and below, we can use this body to body, but we will use it when we are looking for the liquidity engineering only, but not the break of market structure. If you are looking for the liquidity engineering as your entry, you can use body to body breakout. But if you are looking for the break of market structure, you have to consider week to body breakout even in the 15 minutes. So you have to know that, and you have to differentiate that. See? So this is what we call body to body breakout. So if and the last type of the break is week to body breakout. What we mean is that this longest week that found on this side has to be broken by the body in this continuation phase. So if this body comes and closes above this previous week, this is how we identify our break of market structure in our constant time frame. I mean 30 minutes and above. But also, if you are looking for the break of market structure, as I mentioned before, that if you are looking for the break of market structure on this 15 minutes time frame, you have to consider also the week to body breakout. But there are some scenarios or some issues that many traders they face, but also these issues like but there is some issues, there is some mistakes that many traders makes when they are looking for this break of market structure or transition, especially when they try to mark them. So I'm here to show you how to avoid those mistakes. Is that, let's say we have this as the maybe the bullish candle. Let's say this is the bullish candle like this, and then we had something like this. Maybe let's say this is the bearish candle. This is the bearish candle like this. Let's say this is the bullish candle this is the bullish candle. So many traders, they fail to mark this break of market structure when they find something like this. Let's say this is the highest point, so we know maybe we have this is the longest week, but also this is the shortest week, let's say. So we know that we have to mark here as our break of market structure. So if the market close above, there is where we will put our break of market structure, right? But there are some scenarios may happen like this. Maybe you have this highest point here, but you have this previous bullish candle which has the longest wick than this one, than the one that is found on the highest point. So some of traders, they mark this wick as the break of market structure. They are waiting for the market to close above this wick here and not this one, so that they can say, now this is our break of market structure. Let me tell you one thing, this is So wrong. And if you are doing this, stop immediately, because you have to ask yourself that, is this the highest point? So if the answer is no, why you want to put your break of market structure at this level? So what do I mean here is that when you face the challenge like this, you have to mark the longest wick that is found between these two candles that forms the highest point, and not this one. Not this one. And even you may find it maybe on this level, this here, this candle here. Not this one. This is not the break of market structure. You have to mark this one, because these are the candle that forms the highs, and not this candle. This is just a bullish candle with the bearish candle. So it means here there is a up and down. The market goes up, then down. So this is the highest point. This is the lowest point. So you have to mark the wick that is found in the highest point, not this one. Because if you go to the line chart, you won't see something like this. You won't. You will just see the line, only the line like this. So you don't have to mark the wick that is found in the previous maybe bullish candle that has no that is not the highest, right? Sorry, English is not good, but try to understand. So that is the mistake that most of traders they are making. So in this scenario, we will consider this one as our bullish market structure. But also you may find scenario like this, show you. Let's say this was the bullish candle, then this was the bearish candle. Let's say this was the bearish candle, like this. You may find something like this. You may find something like that, like this. Yeah, you have the up and down. Yeah, you can see you have the up, down, then up, then down. So in the scenario like this, if you see this, one of these two candle has the longest wick, longer than the wick that are found on this high here. Here is where you will mark your break of market structure, and not here. Why? Because this is the first high created. So it's like a resistance like this. The market just created the high, and this one maybe want to break this high and then failed, so it went down. And then again, if the market will come and then reacted to the same level and then sells, it means this high is very strong, so that's why these two highs failed to close above this one. So it's like here, this was the first highest point here. So this we will term this move tries to break this high but failed, and then goes down. So if the market will come and try maybe to and break, we don't have to put our break of market structure at this level, because we know the zone that the first high created was this one and not this one. This tries to break that level but didn't break that level. So in this scenario, you will have to mark this as your break of market structure and not this one. But in this case, you have to mark this one as your break of market structure. Try to differentiate, because here we don't have ups and down, we don't have high or low, but here we have the high and the low. So there was maybe one candle or maybe two of them, whatever, but this scenario is different to this scenario. So that is how we mark and we identify the break of market structure, but also the transitions. So I hope for those who didn't understand my last video, they're now understanding. So let's jump on this breakdown analysis, and let's start with this AUDUSD. I had the entry last week on this level here, and it activated my first take profit, but the second take profit was not activated and the price took me out. So I'll just show you the process how this price went. So let's start with, I had this break of market structure at this level here. As you can see, the market came and reacted for the first time, but also the market also came again. As you can see, the market breaks this low by the week, so the market came again to this zone here and reacted to the second time for the second time. And then after the market reacting to that level, as you can see in this level, so let's cut the chart from this point and let's go back to the 1 hour. As we know how we trade type 2 is that we want to see after the reaction, we want to see the market just changes the character, but also give us the inside information like this. This is how we trade type 2. After the market reacted to that level, the market, we were waiting for the market to change at this level here, but not only the change, but also we want to see the inside formation created before that change of character. So what you can see is that the market just creates the change of character and then breaks above. So now we have the type 2 entry. Now we have the type 2 entry because we have the change of character, but also we have two inside formations. So I marked this one because this was the below one, and as you can see, the market was didn't took this inside formation 50%. So just mark this one and then goes down to this 15 minutes, and then the 15 minutes, as you can see, the market was only created, we have this liquidity engineering here in the which is found inside this inside formation that we found in the 1 hour. Then after seeing that, I just go back again to the lowest time frame because I know that if there is another liquidity down there, the market will come and collect those liquidity. So what you can see here is that we had this inside formation down here which was not yet taken, so I put my entry from that point. And then when you go back to the 1 hour, what we were expecting is that the market has to come to take this entry from that point. So what the market did is that the market just goes up and then finally came back and our first take profit on was at this level because this was the change of character. So inside this level we have some liquidity, so the market can sell from this point, but the last take profit was at this level here. So as you can see, the market just activated our entry at that point and then activate the take profit from that point, and then after that take profit being activated, the market just came and took us out. So that is how AUDUSD was traded, but didn't give us much pips. Another entry was the audience. I took this trade from the daily time frame, and it was from this level here. So let me cut the chart at this level here. Cut the chart at this level here. As we see here, this was the aggressive entry, and I know my students know why I took this as my aggressive entry. So as we know here, as we see here, we have this break of market structure at this level here. Market twist this was the break of market structure. So after having the break of market structure there, we know that this is our area of liquidity. So after having this as our area of liquidity, I just go back down to the lowest time frame, the 15 minutes time frame. I know why, and because this is the aggressive entry, so I just need to go down deeper to find the inside formations that is in the below time frames, 5 minutes, 30 minutes and below. So as you can see here, we were having these two inside formations, this one and this one, but the second one was not yet taken, but the first one was already taken. So what to do is that we will go back down maybe again, or you can mark this one as your entry, but you have to know maybe how many stop loss this entry offers you. As you can see, it was the 17 pips. It was a good trade, but for me, I just go back down again to the lowest time frame to find a good area so that I can take my entry. So what you can see here, I saw that I have this inside formation here. This one, this was not taken. This was not taken, and it was offering me about only 8 pips from my entry to the furthermost deviation. But what I do is always I put my maximum stop loss so that I will be sure that this entry won't take me out. So I put my entry from that point, and then when you go back to the maybe 4 hours or daily time frame, whatever, let's see how this market went. The aggressive entry, as you can see here, is that now this was the furthermost deviation and this was the stop loss here. So what the price did, as you can see, the price just came and activated that entry and then moves above. So that is how NZD was traded. But another entry was the Euro USD, and in the Euro USD I had 2 entries. The first one was the aggressive entry, which I found from this point, but I didn't took that entry because my criteria was not met. So I took the type 2 entry from this point. Let me show you. As you can see, this was the daily area of liquidity. This was the daily inside formation, but also this was the daily change of character. So I was very sure that the market has to come to this level and then sells. So what I did, I just go back to the 1 hour. After going to the 1 hour, I saw that this was the aggressive entry. This one, let me show you. This one, this was the aggressive entry. As you can see, this inside formation was taken by this week. So what we know is that this was the inside formation. Let's leave this. This was the aggressive entry, so let's not talk about it. Let's talk about the type 2. What we can see here is that this was what we know is that this was the daily area. This was the daily inside formation. So after the market reacting to the 1 hour, what we need to see is the change of character of the inside formation, right? So after the market reacted for the first time, as you can see here, this was the first time, the market didn't give us the inside formation. The market just changes the character, but didn't give us the inside formation. But the second time, when the market reacted, the market didn't even give us the change of character, or the area that we can consider the change of character. But the third time, after the market reacting, the market changes the character at this level, give us this inside formation here. So for the first time, let me try to draw this. Let's say this was the daily area, and the 1 hour time frame. In the 1 hour time frame, the market just came, reacted for the first time, changes the character but didn't give us the inside formation. The second time, the price just came inside but didn't give us even the area to consider as our change of character. But the third time, the price just came, reacting, and then give us the inside formation, which is this one. This is the third time. So after giving us this change of characters, this inside formation, we are now sure that this is the type 2 entry. So what I did is that I just mark those levels that I showed you. just mark these levels. Just mark this level here as my change of character, and then after marking this as my change of character, I know that the market has to return to that level so that it can take those liquidities and move down. So this was my inside formation, so I will mark it like this and then goes down. So when you go back to the 15 minutes, you don't see anything inside that level, as maybe this was the inside formation that we see in that inside formation. So let's go back again to the 30 minutes. In the 3 minutes, what you can see here is that we have this inside formation up here, which was not yet taken, this one. So I chose this one as my entry, and then after marking that as my entry, just go back to the 1 hour and wait for the market to come to react to that level. So what the market did is that the market just came, reacted to that level, and then the first take a profit was at this level here. The market activated our first take a profit, and that was it. That is how this type 2 was traded, because after that the market just came up and took us out. For those who didn't take their profits, the market took them out and then goes down. So that is how USD was traded. But another trade, which was from the GBP NZD, which was the buying trade. Yes, which was the buying trade, and this trade, it was from this level here. It was from this level here. As we see here, we had this as our break of market structure, but also this was my very powerful setup. Some of my students knows how it works. This was a very powerful setup. So what the price did is that the market just came, react for the first time, and after the reaction, what we can see in the 1 hour, the price just give us this after the reaction here, this level here. After the first reaction, the market didn't give us the change of character with the inside formation. Yes, the market just give us the change of character without the inside formation. As you can see, this was the change of character, and we don't have any inside formation here. And after that, the market, we were expecting the market to respect this level here, this low here, which was our furthermost deviation, but the market didn't respect that level and breaks below. So after this market breaks below, we were waiting for the second confirmation. So as we know, this was the daily area, so we termed that the market just came again to the daily area, reacted for the second time, and now we have this change of character here, but also we had this inside formation, which was the type 2. So I didn't take this inside formation. I took because the market was already came inside this level and took the entry. So what I waited is that I waited for the market to change, to break the market again, so that it can give me the break of market structure, and that will be the matured shift. So it will be easy for me to trade that shift. So what the market did is that let me cut the chart from that. So now we have the change of character of the inside formation, and the market just came and took this inside formation, which is the type 2 entry, but also the market give us the break of market structure, and these are the inside formation that found after this break of market structure. So I marked this break of market, this inside formation that found inside the after the break of market structure, and then I go back down to the 3 minutes 15 minutes time frame to see if I can find another entry, another inside formation down here. So what I found is that I had this inside formation here. You see that inside formation, which was already taken. As you can see, this was the black candle that closes above this inside formation. So after that, these wicks came and takes those liquidity inside that level. So the market, if the market came won't react to this inside formation because it's already taken. So what we see here is that this was the break of market structure, but what you can see here is that when the market came to this level to consume these liquidities, the market failed to consume this inside formation in the 15 minutes time. So what now is that maybe the market, because we had the remaining liquidity after the change of character, because the market just gave us the type 2 entry, the market came and took some liquidities but didn't take this inside from this liquidity here, and then created a new inside formation with the break of market structure. So the market may come and then took you out from this point and take the liquidity at these levels and then goes up. So there are sometimes the market can do that, but also there are sometimes the market won't take this liquidity, it will take this one. So there are two scenarios. Sometimes you have to know if the deviation process is completed. You have to know, it will help you to know that now the market will come to this level and not this one. But if the deviation didn't verifies, it means you will take this inside formation over this inside formation here. But what I saw here is that, let me try to clear. What I saw here is that I thought that the market will come maybe to this formation, but I have to be sure. So when you go back to the 5 minutes time frame, what I found inside the 5 minutes time frame, you can see that this was the inside formation that was not yet taken. So instead of taking this as my inside formation, I would take this one as my entry, because I know the deviation will occur and we don't have any liquidity down here. So this is the remaining liquidity that the market didn't took. So I put my entry from that point, and then if you come to the 1 hour time frame, so what we're expecting is that the market will took these people who put their stop loss at this level, this was almost deviation, and take the entry below this level and then goes up. So today I won't talk about the deviation, and maybe one day I will talk about this concept, but for now I won't talk about it. So what you can see is that the market just came down, took the entry, took these people out. They were given some pips at this level, but after that the market just took them out because this was the stop loss, their stop loss. So the market took them out, took the entry at this deviation level here, and then goes up. Another trade was the GBP/USD, and in the GBP/USD we had the sell entry, which it was from the daily time frame, and it was from this level here, as we know, and it was the type 2 entry. Let me show you one thing. As you can see here, this was the level, this was the daily break of market structure, and this level had this inside formation, this inside formation, this inside formation. So this is the daily level. What you can see, the market just came for the first time, reacted to that level, then sells, and now the market, I think it was, no, the upper one, sorry, this one, sorry, this was the break of market structure, and this was the inside formation that is found inside this level. But we know this is the break of market structure, and this was the inside formation. So as you can see, that the market just came and reacted to that level. So after the reaction, what we have to see is the type 2 created, right, in the 1 hour time frame. So what you can see here is that when you go back to the 1 hour time frame, let's cut the chart from this point, you can see that the market was already changes the character and leaves us with this inside formation. So this was the change of character, and this was the inside formation, which is not yet taken. So after knowing that this is the type 2 entry, and this was not the break of market structure. This was not the matured break of market structure. This was not the strongest break of market structure. So what I noticed is that because this is the inside formation that is still available, the market will come to this level, take those liquidity, and then moves down. So what I did is that I just go back and define that level. So let me cut the chart of this level. And then let's go back to the 5 minutes. And in the 5 minutes, what you can see here is that I had this inside formation which was not yet taken. But when you go back to the lowest time frame, which is the 1 minute, is that you find that you have this inside formation up here which is not yet taken. So I put my entry from that point, and then I list the 15 pips as usual. So what I know is that the market will come and take the liquidity from this point and then moves below. So what the market did is that the market just came, take the liquidities, and then moves below. And that is how GBP/USD sells from this point. And if you go back to the daily time frame, you can see the market sells from that point till today, I think. So that is how that type 2 was taken. Another entry, it was from the GBP card. It was from the GBP card. And from the GBP card to this trade at this level here. This level, I had the entry from this point here, because what we know here is that this was the break of market structure, and the market just came and reacting from to this point for the first time. So after the reaction, if you just go to this, let's mark this level here, and let's go back to the daily time, to the 1 hour time frame. What you can see is that the market just changes the character at this level here, and also give us these inside formations here. So what we know is that the market has to come to that level to take those liquidities that are found inside that level. So when you go back to the 15 minutes, you don't see anything, and when you go back to 5 minutes, you don't see anything, and when you go back to 3 minutes, now you can see that you have this inside formation here which was not yet taken. And if you measure the stop loss from this point, it was the 20 pips. So you can maybe risk 15 pips from that point, or you can just go back again down to define it more if you can find another liquidity down there. So what you can see is that we had these liquidities was already taken. Yes, this liquidity was already taken. This one is not. So we'll go back to the 1 hour time frame. You're expecting the market to come and activate the entry from that point, because that was the inside formation that was not taken in the lowest time frame. So let's play the chart directly. Let's see if the market came. As you can see, the market just came, activate that entry, and then if you measure the stop loss from this point to this point was 6 pips. So if you put your stop loss to this was 16 pips, 15 pips, it was okay. That is how this trade went. Yes, so that was the GBP card trade. That was the GBP card trade. And another trade, it was the USDC chef, which was a very good entry, and it was also the type 2 entry. As you can see here, this was the break of structure, which was the minor. So this was the break of market structure, daily break of market structure. As you can see, the market just came and reacted to that level. So what we have to see is that we want to go to the lowest time frame, which is the 1 hour, to see if we have the change of characters, the inside formation. And what you can see here is that we had this one as our change of character. Why this one and not this one? It is because this was the low, this was the high, which was broken, and after this break, this high was not broken. So this was the last high broken, and this is where you will put your transition. It's like this one. Maybe you can draw something like this. The price breaks, and then the price failed to break this level here, so if the market breaks, it means this is the change of character. Also, this one is the change of character, but this is the main one, because we know this was the last high broken. So this is where we will have to mark our transition. So after knowing that, I had this entry, which is the powerful entry for me, so I took this as my entry. So when you go back to the 15 minutes, you can see also you had this flip, so you can take this as your entry, because that was the flip entry. Yes, so I had this flip liquidity engineering up here, and then when you go back to the lowest time frame, you're expecting the market to come and react to this level and then goes down. For those who knows, that was the entry type 6. Yeah, so what you can see, the market just came and reacted to that level and then sells below. So that is how we traded that level, that entry. But also another pair was SAR USD. The SAR USD, we took this entry from the daily time frame, and I took one entry. This was the change of character in the daily time frame, as you can see here, and the price just after changing in the 1 hour time frame, you can see that we were having this kind of like, this was the, if you go back to, we were having this change of character here in this break of market structure here, and what we know is that the market will come to this break of market structure and then moves below. So what we know is that we had this change of character here also in the 1 hour, and this is the break of market structure in the 1 hour, and we know that in the daily time frame we have the change of character at this level here. So this was the good information for us. So what we know is that we have to consider some liquidities that are found inside this level here. So what we do is that we go back to the lowest time frame. Now we can see we have this structure here, so we can mark it as our inside formation, that this will be the first reaction, because this is the very powerful setup. And then what we have to do is just to go back down again to find if we can find another liquidity inside that level. What we can see here is that we didn't have any inside formation available. Because at this level we don't have anything. This inside formation here was already taken, this was already taken, this was already taken, this was not. So you can put the entry maybe from that point. So if you go back to the 1 hour, what we're expecting is that the market has to sell from that point first. So I didn't took this entry, but the market did that, and after that I had another entry which was formed after. Let me try to show you after this break of market structure here. As we know that this was the change of character and this was the break of market structure. So after having this break of market structure, I knew that the market will come to this level and sells below. So what I did is that I had this inside formation which has this structure here, which is also the very good setup for me. So I marked that inside formation, and what I did is that I want to see if within this level here I can find any inside formation. So if I have any inside formation inside this level, I will take that as my entry because I know the market will come to that level because of some criteria. So what I did is just to go back to the 5 minutes, and if you go back to the 5 minutes, you can see we don't have anything inside this level. We have this inside liquidity engineering which was already taken, as you can see, but we don't give up. So let's go back again to the 3 minutes to see if we can find another liquidity down that is found inside that level. Let's give it time. And now what you can see, still we don't have anything. The 1 minute, what we want to see is the inside formation, only the inside formation. And in the 1 minute time frame, you can see we had this inside formation which was not yet taken. So I put my entry from that point, and I risk only 15 pips as usual. This was 30 pips, 15 pips it was from this point. This is 15 pips, so I risk that amount of pips, and after risk this amount of pips, let's see how the market reacted. As you can see, the market just came and activated my entry, and that is how we took this USD from this point, and it went about 280 pips. So thank you for watching, and have a good